Hey everybody, it's Maureen, your local lender with rates, here with this week's Mortgage Minute. So first, let's talk about interest rates. Well, they improved this week. The average top tier 30-year fixed rate fell to around 6.55%, which is down from 6.6% last week, and it's now sitting just above the low of 6.54% we saw on June 16th. So we're still very much in that same lower range, and this was one of the better rate days we've seen since mid-May. A big reason for that improvement was the bond market. We saw strong bond buying this week, which helps mortgage rates move lower. Falling oil prices, well, that also helped because lower oil can ease inflation pressure, and inflation is still one of the biggest drivers of where rates go next. Now, let's talk inflation and the Fed. Markets are still focused on inflation after this last week's Fed meeting. The Fed, as we know, held rates steady, but the tone was a bit more hawkish than many had hoped. And with that said, this week's big theme was the drop in oil prices. Oil has fallen sharply from the recent highs and is now back near $70 a barrel, which is a positive sign because energy costs had been one of the biggest reasons inflation was heating back up. We're also watching the PCE inflation report, in which is the Fed's preferred inflation gauge, and expectations for that is that it still looks a little elevated in the data, but the market may look past some of that because this report reflects May, and since then, oil has come down significantly. Now, if inflation starts easing again in the incoming reports, that could be helpful for interest rates. And housing data, well, that was a mixed bag this week. On the existing home side, pending home sales rose 3.8% in May, much stronger than expected, and that marks 4 straight monthly gains. Now, on the new construction side, as we discussed last week, well, new home sales fell 7.3% in May to an annual pace of 580,000, which is well below expectations. A few more important pieces of the puzzle, well, mortgage applications, which were fairly flat week over week. Initial jobless claims, well, they came in at 226,000, and continuing claims rose to 1.8 million. In the rental market, well, rent growth is slowing. The latest rental report showed rents up 1.4% year over year, which is down significantly from 2.8% this time last year. That's important, guys, because shelter costs feed into the inflation data, and slower rent growth could help inflation cool further over time. And what does all this mean to you right now? Well, rates have improved modestly, and if inflation continues to cool and the labor market softens a bit more, that could create room for additional rates improvement. And we're not out of the woods though yet, guys, but this trend this week was definitely more encouraging than what we saw after the Fed meeting. So that is it for this week. As always, I hope you like, share, and I look forward to seeing you next week.